Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 31st, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, we're seeing futures opening the week a bit mixed, down on the Dow. Dow Jones futures down about 150 points. S&P 500 futures down about 15. NASDAQ futures, though, up about 10. So we're a little bit of bifurcation in the futures. We'll see how things open in just a little bit later this morning. Let's go ahead and go through the agenda for today, and then we'll kind of get things going here. I'm going to start off with the daily market recap from Friday's action. Of course, the market was closed on Monday for the Memorial Day holiday. Then we'll get into talking technically, inflation and the Fed, earnings spotlight, and 3 you must see. Before we get into any of that, though, I do want to take you over to Earnings Beats. If you go to earningsbeats.com, a couple things just want to point out. We have extended our spring special. It was supposed to end yesterday at midnight. We're actually extending it one more day. Got a lot of new members in and want to make sure they have time to kind of evaluate the service. But if you are interested in checking out our service, or if you are a new member or even current member and just want to extend for another year or longer, this is the best deal we have all year. So you can come in, you can click on this to get more information, but we have extended through the end of the day on Tuesday. So through midnight on Tuesday, the 31st. You can check things out and become a member and extend under our best deal of the year. Also, if you scroll down, you'll see an area where you can subscribe to our Earnings Beats Digest. This is our free newsletter. We've got a huge community. This is a great way not only to learn a little bit more about how we approach the market, but it's also a standing invitation to all of our free events, because we reach out to everyone on this EB Digest subscription list anytime we have a free event. So we'll send you room instructions and welcome you in. So it's just part of our community. We'd love to have you. All it takes is a name and an email address. No credit card required. You can unsubscribe at any time. 3 times a week newsletter, Monday, Wednesday, Friday. I think you'll get some good information out of it. Hopefully it'll be educational. That's what it's intended to be. And there may be some trading opportunities if you so choose. But that, again, comes out Monday, Wednesday, Friday morning, normally about 8:30 in the morning, an hour. That's Eastern time, so about an hour before the market opens. You can check that out. It's a very, very quick read, 2 paragraphs in a chart usually. And I mean, just, few sentences in a chart. Try to visually show you what we're trying to point out. And like I said, I think it's something you could incorporate into your own trading strategy. I think you'll get some great ideas there. So be sure to go to earningsbeats.com and enter your name and email address in the area provided. Hit that subscribe button. All right, so let's move on to what happened to close out last week. It was a very, very solid Friday. Really a great week. Market hadn't seen that kind of a week in a long time. Dow Jones Industrial Average finished up 575 points on Friday. S&P 500 was up 100 points. The NASDAQ was up 390 points. Mid caps up 57 points. Small caps 28 points. When you look at it across the board, percentage-wise, the Dow gained 1.75% on Friday, and that was the weakest group. The NASDAQ gained 3.33%, so 3 1/3% in one day. Pretty strong action, but we've seen this volatility. It's just nice for it finally to go in the direction of the bulls for a change. Haven't seen that a whole lot in 2022. And when we have, it's been fairly short-lived. So we'll see whether or not this has a little bit more legs. I like the fact that we're at least in the beginning of the month. That's when new money comes in. So typically money flows will drive the market higher at the beginning of the month. Not always. This isn't a blanket statement. I'm certainly offering no guarantee, but the market has gotten into a better mood. We can see all the major indices got back above their 20-day moving averages. And that all happened ahead of the money coming in, which starts today. A lot of the new money will come into the market. So we do have a chance here, I think, to extend this rally in the near term. Of course, we've got jobs report later this week. So this could be very volatile. We're going to have I think the CPI comes out either next week or maybe the early part of the following week. So we got inflation news that's going to be coming back out again, big news, and that'll be a couple weeks before the Fed decides what they're going to do. Of course, they're pretty much telling everyone, telegraphing that they're going to do a 50 basis point hike. So I don't think that will surprise anyone, but their language could, depending on how the jobs come in, how the inflation report comes in. So a lot coming up here over the next few weeks. Far as the sectors go, you can see discretionary. Discretionary had a great week. I'll show you in a minute just how great it was. But on Friday, the XLY was up 3.4%. Technology, 3.4%. Real estate, 2.8%. Materials, 2.3%. And communication services up 2%. So the three that I really like to follow, discretionary, technology, and communication services, these are the three, in my opinion, that are the most aggressive. And when they lead to the upside, that tends to be a good thing. Now we are getting a counter trend rally. So the general trend in the market in 2022 has been one of a cyclical bear market nature. So it's been going down, obviously. If you've been following the market, you know what I'm talking about. But last week was kind of a counter trend move back to the upside. And the question is always, well, is this the real deal? Is this the one? Really hard to tell, to be quite honest. I mean, there were no signs ahead of this past week that said, hey, we're bottoming or we've bottomed. So I would probably still be a little cautious with this, but let's accept it for what it is. I mean, we are moving back through some key moving averages. So at least in the short term, it looks good. And I think the key for the market is going to be what happens during the next move to the downside. What leads to the downside? Do we go down and do we set new price lows in consumer discretionary and technology and communication services? Or are those groups spared on a relative basis? And do we see the defensive groups moving down? You know, is it that rotation where Wall Street's moving into aggressive areas on the move down, kind of like the market moved into defensive areas on the way up back in December? That was a warning sign that we were topping, along with many others. So we're going to kind of look for the flip side of that to help identify a bottom. And I'm not seeing that yet, but we haven't gone back down. So I think the makeup of what happens here over the next maybe anywhere from few days to possibly as many as few months, I think that's going to be the telling tale here for the market. So we need to evaluate this as we move forward. Of course, we're watching the strength, and the strength looks good right now, but it usually does on rallies. If you go back to the March rally, you would see the same thing. The aggressive groups leading. It didn't last. We went to new lows. So that's what, in my opinion, that's what we want to be watching for as we move lower. Where does that money rotate to? What's leading to the downside? What's lagging? That'll give us a pretty good idea of whether or not we're going to new lows or not. All right, 10-year Treasury yield. We got a few economic reports out for later this morning. The first two, I mean, you probably can almost ignore them. The first one is the March Case-Shiller Home Price Index. It's expected to rise 2.2%. February was up 2.2%. The problem here is it's March's report. Look at the 10-year Treasury yield. It started going up in March, but we really picked things up, went above 3% in April, and we've seen a lot of these housing reports not coming out very strongly, the ones that have come out for April or even May. This one, March Case-Shiller Home Price Index, is going back to March. Same with the March FHFA House Price Index, which is expected to rise 1.9%. We're talking about March numbers. I really think April is where we're going to start seeing weakness in both these reports. And of course, we're not going to hear about April today. So this is a lagging. These are both lagging reports. Housing market already has taken a big hit, starting to bounce back a little bit. I think the market's going to ignore this, whether they beat or miss. I think the housing group's just going to trade based on its own technicals at this point. We do have the May Chicago PMI coming out later this morning. Estimate there, 57.1. April was 56.4. So we're looking for a slight uptick there. May consumer confidence looking to come in at 104. April was 107.3, so a little drop in consumer confidence is what is expected. Again, that number 104 later this morning. Looking at the 10-year Treasury yield, I mean, we've gone down to the 50-day. That when I started talking about this, I don't know, a few weeks ago, you see the high here and that lower PPO. I talked about that point, maybe the range and to the downside being 265 to 275, and perhaps testing that 50-day moving average because of the negative divergence. Notice how as we were moving up, for the most part, we were holding that rising 20-day EMA. We had a slight negative divergence back here, higher prices, slightly lower PPO. We got that 50-day test, went to new highs. Last high, lower PPO, negative divergence, right back down to the 50-day. This, in a nutshell, is how I use the PPO and the moving averages together. When you're breaking out and you're moving up and that PPO is coming up from the center line, normally the pullbacks hold at 20-day. When you go up, you set new highs and you can't get a new PPO high, then I look for a 50-day test. Reset the PPO. Back up, PPO up, pull back, we hold the 20-day. Back up again, new high, hold the 20-day. Move up one more time. We don't break out on the PPO. Negative divergence, 50-day. PPO strong, 20-day test. PPO weak, 50-day test. That's, in a nutshell, how I use it and how effectively it can be used. There's your 50-day, or excuse me, your center line test, 50-day test, center line test, 50-day test. Now, once you get the negative divergence, you're looking for the reset, but we don't know at this point whether or not we're going to break through to the downside or whether we're going to turn back up. This could have a big impact on the equity market. If rates start to break back down again to the downside, that's going to be an indication from the bond market that it's no longer worrying about inflation, and it's more worried about a weakening economy. So you want to keep an eye on this. This is going to be another indicator. It's another piece of the puzzle. You know, a lot of folks look at one thing and they're like, oh, this, every time this happens, the market does something. Or, you know, most of the time when this happens, the market does, well, it's just one indicator. You got to look at more than just one thing. You got to kind of put the story together. You know, you don't get a book and read, 52 chapters and you don't read just 5 of them and figure out what happened in the book. It's really hard to do. You need to read all 52 chapters. And I think when you're looking at the market, same thing. You got to look at everything. You can't just find one indicator to support your argument. That's confirmation bias. Those of you who follow me know I tend to be very bullish. I like to be bullish. The market goes up more than it goes down. Those who like to bet against the market, I don't understand it, because historically the market goes up more than it goes down. By default, you're going to be wrong more than you're going to be right. Everybody always wants to call a bear market. And then when you have a pullback, it's like, see, I was right. Well, no, really you're not. Not if you're always bearish. If you're always bearish, you're almost always wrong. So I like to pick my spots when I'm bearish. I mean, I have to see the market really giving me bearish signals. I got all those back in December. Not now, not in March when it was free falling. I got it back in December and wrote about it, talked about it on the air, let all of our members know. We've got members at Earnings Beat's been in cash all year. I know because I get emails. They're waiting. Patience. I mean, that was probably the word of 2022. I would say volatility might be the other one. Going into the year, not now, going into the year. Volatility and patience. Anyway, let's move on here. S&P 500. So, for talking technically, what I want to do here is just go through the S&P and maybe look at some of the sector rotation. So here you've got the S&P 500 here breaking above the 20-day. I don't know if we had a positive divergence. It's pretty close, maybe equal PPO readings with slightly lower closes. Remember, this is based on closes. You might look at this and look at candle bodies and not see the actual positive divergence. But the way you look at a positive divergence, the best way is to get rid of a candlestick chart and use a line chart. sometimes you can't see the closes. You're looking at the candlestick bodies and it doesn't become clear. I think it's pretty clear here. We have lower lows, lower low closes, or lower closes, I should say. And then here, again, I don't know. I mean, we'd probably have to pull up that day's PPO and see what the reading was. Very, very close. Point is, price action keeps going lower and it doesn't look like the PPO did. So maybe we have a slight positive divergence, which tells me that there's a chance maybe we get up to the 50-day on this move as opposed to the 20. See, again, how we keep going lower and lower, and see how that 20-day seems to be as far as we can go. And then we put in what appears to be maybe a slight positive divergence, and then we bust through. And it's also the beginning of the month now, end of last month, beginning of this month. I've told our members that is a bullish period, end of May, last week of May, first week of June, tends to be pretty bullish historically. So we're following that historical pattern, and maybe we've got a little bit more upside. I would, as we get closer and closer to that 50-day, and look at 4,300, how we failed a couple of times. So, if we keep strengthening, we get above 4,200, then we hit 4,250. I believe we're starting to get to the point where the reward to risk really begins to shift back toward the bears. We still have the summer months ahead of us. We got to be careful. They tend to be not so great. July to September, mid-July to September, end of September, that's the worst period of the year historically. We don't go down every year, but again, probabilities are that we'll struggle during those months. So I'm thinking that maybe the bottom will go in sometime during that period, maybe sometime in September. Maybe we have to just kind of sideways consolidate, maybe one more swoop to get those last few. Anybody saying, okay, this is it, market, here we go, back to the upside. Might need one more move down, kind of shake those folks out. But I think we're really close. If that wasn't the bottom, I think maybe we have one more. I think we're going back up, and I think we're going back up in a big, big way. But that might have to wait until the fourth quarter. Maybe this is it. Maybe it waits till the fourth quarter. My guess is it's probably still fourth quarter, but we'll, kind of play it by ear, watch the market, be patient, and try and see if maybe we do have one more low and hopefully catch it there. All right. Sector summary. So let's talk a little bit about the sectors and what happened last week. This is a 1 week period. S&P sectors, if you're unfamiliar with how you get to this, if you're on the just your dashboard, if you come down here over member tools and go down, you'll hit charting tools, and then you come down to summary pages. Under summary pages, there's your sector summary. Here, the period defaults to intraday. So it's just 1 day. This is what happened on Friday. Really good action, consumer discretionary, technology. These were the groups I gave you at the open. These 5, this is what led. All 11 groups, by the way, were up. It's just what's up the most. And those were the groups that were up the most. Now, if we stretch it out, we can go out to a week. And that's what I was showing you. So here's a 1 week summary of the sectors. We've got consumer discretionary, 9.5% last week. I mean, that's a decent year. We did it last week. But it came on the heels of crazy selling. So if your timing is absolutely perfect, then you had a great week last week. I mean, if you found the bottom on the XLY and could ride it up 9.5%, I'd call that a pretty good week. An excellent month and even a darn decent year. But it was just 1 week, and it was rallying off some very depressed levels. So, I mean, movement to the upside is going to be somewhat dictated by how much you went down. If you go down 10% or 20% or 30% over the last several months, or 50%, then a 1 week move back up 9.5% isn't that great. Now, if you've been going flat for the last few months and all of a sudden you up 9.5%, that's a huge move, big breakout. That's not exactly what happened here. We've been going down a lot this year. We got a big rally, probably fueled by the fact we were very oversold, probably a lot of hedge funds, portfolio managers getting in before the money comes in at the beginning of this month. That's typically what happens anyway. But if you look at the leaderboard for last week, you've got consumer discretionary. Of course, energy's just been having a phenomenal year. It's back, to new highs. Financials had a nice week. Rates have been coming back down. Maybe inflation is taming. My call was that inflation peaked with was it the April CPI reading that was released in May? No, it was the March that was released in April. Annual rate of inflation actually came down last month, the core CPI, and I think it's going to come down again this month and next month. So my call was we peaked with that March reading, which was released in the second week of April. That's, in my opinion, when inflation topped. When we go back and look at history a year from now, I think we're going to point back and say that was the top. People look at me like I'm crazy, but we'll see. I think it was the top. I think now we're going to start to see inflation just kind of moderate. I don't think it drops until later this year. And when it does begin to drop, rates are going to come down with it, bond yields, and the Fed will put the brakes on raising rates. And eventually, either later this year or beginning next year, I think they're going to cut rates. We'll see. Maybe I'm crazy. Anyway, technology up 8%, industrials up 6%. It's a really good week, Looking down at the bottom, most of the defensive groups, you got healthcare, utilities, and real estate, 3 of the 4. There's consumer staples. So basically all of them in the bottom 6, all the defensive groups. They still went up, but they didn't go up as much. So money was rotating away from those groups and into the groups that were leading, which were much more aggressive. If this continues, that would be very, very good news for the stock market. So if we go up again this week and you see significant leadership by discretionary, technology, financials, industrials, and get some, maybe communication services gets a little love next week, who knows, or this week, I should say. Those are the groups we want to watch to see if they lead. And especially if the market goes back down and they lead. That would be the real key, eventually showing leadership when the market's going lower. Relative leadership. Doesn't mean the groups go up. Market could go back down another 10%, and we could see discretionary go down 7%. Technology go down 8%. Communication services go down 6%. So they're going down, but they're going down at a lesser rate. Normally, it's the opposite on the move to the downside. So that would actually be a positive sign, something to watch for. Anyhow, talking about discretionary, here is discretionary. I mean, it's been beaten up. We had a great week. No doubt about it. Big, big week. But look at what it followed. I mean, here was a really, really nice period of 3 or 4 days. But look at what it followed. Did that 3 or 4 days mean anything in the big picture scheme? No. It was just rally and then another failure. Rally, false breakout, another failure. Rally, where does this go to? I mean, I think it could go up here, at least 162, maybe to the 50-day, and we're sitting at 153. So we could easily have another 5%, 7%. Wouldn't be shocking. So anyway, that's short term. All right, let's move on to inflation in the Fed. So I just wanted to go over, this was a chart that I sent to our members. I thought this was an interesting chart, so I'll share this one with you. If you look back, really the market started to get hit in late 2020. The growth areas, some more than others. If you look down here, this was the mid-cap growth versus mid-cap value, small cap growth versus small cap value. Once the market began to fear inflation, inflation showed up at the beginning of 2021, but I think the market began to be fearful of it at the end of November. That's when we started to see a change in the growth versus value picture, more so at the mid cap and small cap level. In my opinion, large cap growth versus value went to a new high later in 2021 because a lot of those large cap growth names have some protection against inflation. They have pricing power. If Apple's prices go up, they just simply pass it to their consumer, and their consumer buys from them. They have such a big brand name, so they're so popular. So the big growth companies can withstand the inflation scare. What they can't stand is the recession scare. And so here, the inflation scare began, but remember, the Fed wasn't worried about inflation. So the Fed wasn't raising rates. So the market was looking at inflation as being more temporary. Here is when it started to become reality. And at this point, look at the large, well, first of all, consumer discretionary. That right there screams recession. Consumer discretionary just dropping like a rock against consumer staples. But you also had the QQQ dropping versus the spider. The large cap growth versus large cap value dropping like a rock at that point. Mid cap and small cap continued going down. They were already going down. They got hurt by inflation and they get hurt by recession. Welcome to our world. It's a double negative. But when the growth finally gave in, that's when the S&P 500 no longer could stay up. And that's what I kept talking about. When the large cap growth names go, the S&P has no defense. That's the last thing that that the S&P is clinging to. And that's when we kept going lower and we got in the bear market territory. It was because large cap growth fell apart. And that was the second part of the story. Here's inflation scare. Here's inflation really picking up steam. And so that's what we've been dealing with. And with each one of these new lows, these red arrows and the black dotted lines, thin black dotted lines, each one of these new lows, these sustainability ratios were also making new lows. So I'm not seeing anything yet to tell me that this rally is anything other than temporary at this point. Doesn't mean that couldn't be the bottom. We may pull back and get close to this bottom and not take it out. And we could see significant rotation into aggressive areas. So we got to be, on the lookout for those types of things. Anyway, let's move on to earnings spotlight. Just wanted to point out a couple stocks that'll be reporting. CRM, Salesforce.com reports today after the close. It's been downtrending relative to its software peers, not looking very good. So we'll see what happens there. HPQ, I expect to have a pretty decent report. AD line's been going up. Look at the price action sideways, while computer hardware has been going to new lows. Look at the relative strength. So this one reports later today, and I think we could see a pretty good report on HPQ. We'll see. A lot of software companies reporting later this week. So we'll get, technology will have a chance. We'll see what happens. All right, last thing, 3 you must see. I just wanted to show you a couple. Intel still going down. It bounced last week, but relative to its peers, it's trading close to about a 6-7 month high. So Intel, we'll see whether or not we can, sustain this move, but watch to see if the 20-day holds on pullbacks. That's probably going to be the key here. All right. I also wanted to mention, these are two stocks I gave to our members last week. Ulta, down here when it was testing 340 support, I said if it doesn't close below 340, it could be a great trade. Big move up on Ulta. It also had earnings last week, which were strong. The other one I gave members was Build-A-Bear. Down at this support area, talked about that reversing candle right there. 2 days later, the stock was back up to 20, was up over 20% or around 20% in just 2 days. So candles, support, all these things matter. Anyway, that's it for me. Everybody have a great day. Be back on Wednesday over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.